Okay guys, welcome back to another educational video. As you can see by the title, today's video is based on Fibonacci levels. This is a very important tool to have in every trader's toolbox. We're going to run through why these levels appear, the significance of the levels, why they're important, and how to implement them into your trading plan. So let's get started. Obviously read the disclaimer first, pause the video, take a read of that. Basically it just says I'm not a financial advisor. Any information I provide is intended for educational or entertainment purposes only. Trade entirely at your own risk, and don't invest more money than you can afford to lose. So take a read of that. Purpose of today's videos, again, is intended for beginners and or people with minimal trading experience, so those of you just starting out in your trading career. Towards the end of the video it does get a bit more complex where we go into advanced and harmonic patterns, but that's not really the purpose of today's video. It's just a brief overview at the end. I'll make a separate video on those for that purpose, and there will be content on my website. I'll leave the information at the end of the video for these patterns, but basically today we're going to cover what is the Fibonacci sequence, so a bit of a history lesson there, how the sequence has been discovered, how it comes about, and the subsequent levels from these this Fibonacci sequence, so the ratios that this sequence provides us with, and then how that can be incorporated into trading with the Fibonacci retracements and extensions. Obviously how these can be incorporated into your trading plan to enhance your trading, and then, like I said earlier, just a brief overview of the patterns, advanced and harmonic patterns, seeing as they are based on solely on Fibonacci retracement and extension levels. So it says there, pause, rewind, rewatch, take notes and ask questions. Again, I'll leave all my contact details at the end of this lecture. If you've got any questions throughout, write them down. If I haven't covered something properly, make a note of it and get in touch with me and let me know, and I'll try my best to get back to you on that. So to begin with, the Fibonacci sequence says here first appeared in a book called Liber Abaci by Leonardo of Pisa, better known as Fibonacci to most people. The calculation is used in his book to describe the growth of rabbit populations. So assuming you start with one male and one female rabbit, they start to mate and consistently produce a line of mating pairs of rabbits. So the male and female will produce another male and female, who will produce another male and female, so on and so forth. So you start with one male, one female, and you produce two more rabbits, and then you've got two more rabbits, produce 3, and then 5, and then 8, and 13, and so on and so forth. So without the rabbit example, we're basically 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, so on and so forth. So you're adding the previous number to the current number every single time, and so on and so forth. So that's the Fibonacci sequence. Now once you get up to the 89 level and further on from this, every time you divide one number in sequence by the previous number, so example given here, 89 divided by 55, you get the same value, 1.618. so this is a ratio of 89 by 55, and the further along in the sequence you get, the more accurate you get to this 1618 level. As you can see here, 233 divided by 144, 1.618, 0555. So the next one will be even closer to that whole 1.618 level. This pattern appears in nature all of the time. I don't think anyone really knows why that is. I'll go into that a little bit later as how it can be incorporated into trading, which is probably why it's incorporated into nature. But yeah, so this pattern appears in nature all of the time. The display of sunflower florets are in perfect spirals of 55, 34, and 21, each which is a number in the Fibonacci sequence. This goes for pine cones, pineapples as well, multiple other plants, flowers and fruits. And it's also found throughout the human anatomy. So this 1:6:1:8 ratio pops up a lot. For example, the distance from your shoulder to your fingertips is 1.618 times greater than the distance from your shoulder to your elbow. So the whole length of your arm is 1.618 times greater than the distance from your shoulder to your elbow. So call it half, but it's obviously not half if it's 1.618 times greater. Also applies to the geometry of your hands, face, your fingers, your spine, your legs, etc. So I'll put some pictures up in a second, but just to describe this briefly. So as you can see here, we've got the numbers in the sequence as little squares. So a 1 by 1 square underneath the cursor there. One, whatever unit of measurement you want to use on the left, on the one axis, and one on the other axis, so 1 by 1 square, plus the other 1 by 1 square, so that's our first two numbers in the sequence. Onto the side, that obviously creates 2 on one side, and then 2 on the other side for our other square, which is the next number in the sequence, which then obviously the 2 units of measurement on this side plus our 1 square equals 3. So that's our third number in the sequence, so 3 by 3 square added onto that. Obviously the 3 plus the 1 by 1, or the 3 plus the 2 units of measurement equals 5. So we can add our fifth square on, and so on and so forth, adding 8, which is the 5 and the 3. Then the 8 plus the 5 is 13. So adding these squares continuously creates this spiral shape. If you draw a line joining the corners together, this forms this spiral shape, which is what appears in nature. So if I put some examples up now, obviously the most common way of illustrating this is through a nautilus shell, which pretty much hits this Fibonacci graphical drawing, mathematical graph drawing, whatever you want to call it, pretty much spot on. So this is a nautilus shell. Like I said earlier about the human anatomy, you could apply this to the human hand, whereby obviously the bones in your hand get bigger by the given ratio, that 1:6:1:8. And then you can apply it to the face as well. Matches perfectly to the ear, the structure of the face, different parts, whatever. And then, like I said earlier, the sunflower florets here. So just some examples there of how it occurs in nature. That's just sort of a history lesson. Skip over that if you don't want to. It's not really important. It's just a background on where these levels come from. So on to the Fibonacci levels now. So we've got the sequence. We don't really use the sequence in trading. We use these Fibonacci levels, which is to do with the ratio and the interaction between the numbers in that sequence. So obviously the markets are made up of market participants. Most participants tend to be human. Humans are a part of nature, which we've just described there, how these Fibonacci levels, sequences and ratios appear in nature over and over. So humans are part of that nature, and we work in ways which would obviously suggest this. So human psychology, behavior and emotions are some of the main drivers which affect the markets. Now, how these Fibonacci ratios work and can be applied to the markets could be explained. I don't think there's any solid evidence of why they work, and we'll go over the fact that they actually do work later. But it could be explained by suggesting that humans subconsciously seek out the Fibonacci ratios because traders, and therefore humans, aren't psychologically comfortable with excessively long trends or disorder or chaos. So we've seen there in the previous slide, everything to do with this Fibonacci sequence and the levels represent some sort of order or flow. So humans don't like disorder or chaos. Chart analysis has a lot in common with nature, where things that are based on certain ratios are beautiful and shapely, and things that don't contain these ratios look ugly and seem suspicious and unnatural. So as humans, like I mentioned before, we like order. We do not like disorder or chaos. And the Fibonacci sequence ratios, which we convert to levels, are a way to ensure order within the markets, within nature as well. So it's important to note that these levels act as zones in the market. Again, we'll cover this later. They're not exact levels. As in nature, they're not exact either, but so they should not be used as a standalone trading system. It goes to the same as all indicators. You should not be using one indicator alone as a standalone trading system. I've mentioned it in previous videos. The more, not necessarily the case, but in general, the more indicators you have, this is a very simple way of explaining this, but the more indicators you have, think of each indicator as a filter to your trading. So you've got one indicator. If that indicator indicates, for example, the trend is likely to continue higher, so in a bullish direction, if you add another indicator to your chart and that correlates with that, you've added another filter, or you've pushed the odds in your favor that that trend is going to continue in that direction. It's not always the case. You don't want to go over the top and have 20,000 indicators on your charts, because you'll just get lost and overwhelmed. But in general, the more indicators you have, the more filters you have on your charts. So they shouldn't be used as a standalone trading system. They should be used alongside other tools in your trading toolbox. Now, to cover these Fibonacci levels, so we've got the sequence now. I've obviously showed how you get the ratios from the sequence and the importance of that 1, 6, 1, 8. Now, we convert these into levels, so there's different ways of working this out. I've included the main ones in my opinion for the purpose of this lecture. You will see other people using other levels. There's different ways of calculating them. Some of them are actually calculated, as we'll go through now. Others are just whole round numbers. As we mentioned before, we like whole round numbers because it provides us with some sort of order. So just to cover them now, obviously we've got the retracement levels, which between 0 and 1, and extension levels, which are higher than 1. So you can think of 0 as your starting point, 0%, 1 as your finish point, 100%. Don't worry if this is getting a bit confusing, we'll go over this and with some examples later. We just think 0 is 0%, 1 as 100%. Anything past 1 is greater than 100%. So here we've got the retracement levels between 0 and 100%. So 0.618 level, this is the most significant Fibonacci level and is derived by dividing one number in the sequence by the following. So rather than that original golden ratio, the 1, 6, 1, 8, where you're deriving 1, 6, 1, 8 by dividing the number by the previous number, you're now doing it in reverse. I hope that makes sense. So yeah, dividing one number in a sequence by the following number, i.e. 89 divided by 144, will give you 0.618. Another important level derived by dividing one number in a sequence by the number 2 places to the right is the 0.382 level. Like I mentioned before, the 0.5 level is not really a Fibonacci level because they're not calculated using that Fibonacci sequence. However, it represents 50% of a given value, which tends to be a powerful figure in an orderly world. And like I said, humans, in part of nature, we like order. So that 50% is quite a powerful Fibonacci level. We've got the 786 and the 886 level. It's square roots of 618 and 786. And then the 0.236 level. I personally don't use this level, but it's there, I thought I'd throw it in. Dividing one number in the sequence by the number 3 places to the right. So similar to the 382, but another place to the right. And the extension levels, obviously 1, 6, 1, 8 we've covered. 1, again, like the 0.5 retracement, 1 is not really a Fibonacci level, but it represents a whole a whole, so 100%, which is a nice round number, and we like nice round numbers. 1.272 is square root of 1618. So 1382 is the addition of 382 to one whole, or 100%. Or it's one whole, one whole 100% here for that one. 113 is the fourth root of 1618, or the square root of 1272. 1414 is the square root of 2, and again 2 covered here. It's not really Fibonacci level, but it's double a particular value, or double that whole, or 100%, to give us 200%. So like I said, there's a couple in there that aren't really Fibonacci levels or to do with the sequence, but they're nice whole numbers. So how do we trade using these Fibonacci retracements? We'll go over extensions in a minute. Let's start off with retracements. So that's between 0 and 1. So firstly, we need to identify a swing low, which will be 0 point in this example, and a, sorry, my phone's going off, and a swing high in which to stretch our Fibonacci tool to and from. This is to identify the base and peak of a price swing or rally. So it is important to remember that Fibonacci extension or retracement tools are that just tools. Don't use it as a standalone system again, we've just mentioned that. Later on we'll cover advanced harmonic patterns, however for now this tool will be used as follows. The reason I've chucked that in there is because although I've said it should not be used as a standalone trading system, advanced and harmonic patterns are purely based on Fibonacci levels. However, they're based on a series or specific sequence of Fibonacci levels. So although you're only using Fibonacci levels to determine these patterns, it's a sequence of these which together add up to make the pattern. So you're not just using one Fib level in order to enter a trade, you're using a sequence of which to enter. I hope that makes sense. We'll cover that later. So Fibonacci levels can be used in conjunction with other levels in the market. This goes back to us not using it as a standalone trading system. We want to couple it with something else to enhance our edge over the market. So most commonly, they will be used to further emphasize the strength of certain support or resistance levels. Now, if you haven't seen or heard of support and resistance levels, go and watch my introduction to Forex trading video. They are covered briefly in that. That should be a brief understanding of that, just so you know what I'm on about here. In this instance, they would work well in trending markets. For example, if you are a trend trader, which most beginners and most people generally are, because the odds are against you when you're trying to trade counter trend. So if the trend is up, the market is more likely to follow the trend rather than reverse. You're going to struggle to catch the exact moment that that trend reverses. You're better off trying to catch the market when it's moving in a certain direction rather than try and get a reversal of that direction. I hope that makes sense. So for example, if you're a trend trader, you could use previous structure alongside Fibonacci levels to determine a zone of entering during a retracement or pullback. So if the trend is bullish, i.e. the market is going up, you could use a Fibonacci level to enter a trade when the market pulls back down in the opposite direction of the trend, so trending up. If it pulls back down, if price moves a little bit lower, you can find a Fibonacci level to enter the trade long in the same direction as the trend. So trend's moving up, price moves back down a bit lower. Let's draw this out quickly. So price is moving up, price then retraces back down a bit lower. You can use the Fibonacci levels, which will be something like this, to alongside maybe previous structure, which could be here. So you've now got a Fibonacci level and a structure level to look for entry reasons to go with the trend. So you're looking for reasons to enter long or buy this market, expecting the price to go up. We'll cover that with some proper examples in a moment. Right, so for example, Now I'm going to start with this one because that's what we just said. So as you can see here, price is moving higher. So we've got the initial high, we've got a higher low, and we've got a higher high. At this moment, break of the previous high, we should be considering, might vary depending on your rules, but my rules, this break of the previous high now enters us into a bullish trend. So the trend is up. So we've got higher high, pull back down, higher low again, which is the swing low of our fib retracement, pull back up, another higher high, even strongly, what am I trying to say? Confirming that bullish trend again. So we've got high high, high low, high high, high low, high high, even more confirmation of that bullish trend. And then we've got another pullback to form a high low again, and that pulls back nicely into this previous resistance level, which has now been broken through and turned into support. Now from the swing low, which is our 100% point, pulled up to our swing high, which is our 0% point, so our start finish point, we have got a Fibonacci retracement level matching up with this support zone. So we've got 382 retracement back into previous resistance, turn support at, and the 382 retracement level. So we've been given two reasons to look for entry reasons here. Obviously the resistance turn support, the Fibonacci level, and then these two bars here you can see are indecision candles as well. So the market is market participants are trying to push price higher and lower, neither side is winning, and then all of a sudden we get this pop to the upside, bullish engulfing candle, and that could be our entry reason. And obviously you can see price continues to move higher then from that level. So that goes back to, don't use these levels as standalone systems. You want to, we've got, obviously in this instance, we've got the bull trend, so we know which way the market is moving. We've got the previous resistance turn support, we're into that level, and we've obviously got the fib level as well. And all of that only adds up to look for an entry reason. That's not, we're not setting orders or anything at these levels. We are waiting at these levels to look for an entry reason, which comes in the form of this bullish engulfing candle. If that doesn't make sense to you about the candlesticks, again, I've got stuff on my website. Go over to the candlestick analysis, and I have got a page on there for bullish engulfing candles, and that covers that quite nicely. So go and check that out if this doesn't really make sense to you guys yet. But hopefully the rest of that makes sense. You know, we're looking for the addition of the trend, so we're following the trend. We're not trying to catch the reversal. We're following the trend. We waited for price to pull back lower, so we've got a better risk-reward ratio. We've pulled back into that support, resistance, support, turn support level, and we've got the addition of this 382 level as well. So we've got a multiple reasons for looking to get in on this trade. So I hope that makes sense. If we go back to the original one, just an example of how to stretch your fib retracements. So you want to stretch it from a swing high to a swing low, or in the other case it was from a swing low to a swing high. Swing high to your swing low. Swing is a significant move in the market, so not these little moves. You want a significant move in one direction, so stretch it from the swing high to the swing low. At this point, obviously from our swing low, price has started to move higher. We've come up into a previous resistance level here. We've come up into that previous resistance level. This also correlates with the 50% retracement or 0.5 Fibonacci level. So again, coupling this with the resistance level, we can start to look for entry reasons. And that might come in the form of maybe a double top here, if you'd class that as a double top, and a bearish engulfing candle. Again, like we mentioned on the last one, candlestick patterns are important things to look for entry reasons. So that might be your entry reason, and then you can enter short on this trade based on all of these things adding up. Another nice example here. So we've stretched our fib levels from the swing low up to the swing high. We've got our Fibonacci levels on the right here. So as price is making its way down, you can see this 382 retracement correlates nicely with the previous resistance, now turned support. So we've broken through that resistance level. Price is working its way down. We'll be looking in this zone here to enter long on the retracement again. So like our trend following one, we're following the trend here, swing high, pull back, entering long. So coupling that previous resistance turn support with the 382, we're looking for entry reasons here, and we get that nice rejection candle, sort of an indecision candle, with a long wick to the downside suggests that the sellers are worn out, and we then get a bullish engulfing candle here as well. You could couple this with RSI or another indicator. Again, that's all on my website for free. Check out them. So a description of the RSI. RSI might be oversold at this point, might have some divergence, whatever. But that would be our entry reason to enter long on this trade, with everything adding up nicely. So that's that example. Now the extension levels. So we've had the retracement, like I said, but retracements are between 0 and 100%. Extension levels are anything over 100%. So for fib extension levels, again, identify a swing low and a swing high in which to stretch the fib tool to identify the base and peak of a price swing or rally. Slightly more advanced than fib retracements with regards to trading ranges. It's important to remember that these are tools. Again, couple them with other indicators or price action, whatever. Now, the fib extension tool is used to project price in the direction of the trend rather than counter trend. So this might be useful in projecting profit targets or stop loss levels. For example, if you enter a trade based on a retracement lower into support fib retracement levels, like this, enter a trade based on a retracement. In support during an uptrend, yeah, exactly like that. So we're in an uptrend. We've entered a trade based on the pullback into the support, resistance turn support and the fib level. You can then set targets based on fib extension levels. So we would be extending or projecting the fibs up higher rather than between the 0 and 100%. We'd be projecting fibs higher. So we set targets for that trade. So if you're entering a counter trend trade, this is ideal for stop loss placements. So if we were up at this level and we wanted to enter short, we could use our fib extension to project them higher than the previous high and use these as stop loss levels or invalidation levels. We'll cover this. If that didn't make sense, we'll cover this now. So fib extensions, obviously we've got our fib retracement tool here. We've had the swing high to swing low. So imagine you can't see any of this price action here. We've just had this swing high to this swing low. We pull back up into the 382 zone. That we'd be looking to enter short on this pullback because we want to catch a trade in the same direction as the trend. So we've entered short. For whatever reason, we might get an entry reason on a lower time frame in this 382 zone. I'm not seeing an entry reason here, but maybe on a lower time frame we get an entry reason at this zone. We would enter short here and use the extension tool from the same swing high to the same swing low as the retracement tool. Same swing high, same swing low, but instead of having the retracements between 0 and 100%, we've now extended or projected these fib levels above 100%. So you can see here we've got this, you can't see it very well, but it's 113 zone, that 113 zone we mentioned before, 1272, 1414, 1618, and 200%. So that 200% is the same distance from our swing high to our swing low projected down. So this move here is exactly the same distance as this move here. I hope that makes sense. So we could enter a trade short at that 382 retracement level here, enter a trade short, and we can project our fib levels into the future and potentially use the 1272 area as profit targets because it correlates nicely with the previous support levels. So we'd enter the trade short here, and that's an 86.6 pip move down from our entry, which I've just used as a close of this bearish candle, around that point in the 382 zone, down to the 1272 extension level, which correlates with the previous support. So that's what we're looking for profit targets. Again, same example, so we would have entered short up here, but in this case, obviously we've got initial targets that we've set at the 1272 because it correlates with support. Now, just as an example, I'm not advocating this as an actual trading idea. Just as an example, we've entered short, we've got first targets hit here at the support level. If we don't see any signs of a reversal, we could just leave the trade running, move our stops along with it, leave the trade running, have second targets down at the 1618 level. It says if we don't see an indication of the change of trend. So if we don't see it indicate price action indicate that it's going to move higher, we can just leave this trade open. Take second targets down here. You can see this 1618 level acts as a support level multiple times, bounces off it here, bounces off it here, bounces off it here, and eventually we break through that. And then third targets could be set at the 200% level. Again, if we don't see any indication of change in trend at this point, we just leave the trade running and set third targets at this 200% level. And you can see again here how well that 200% level acts as a support level, hitting it exactly before the trend obviously retraces. We get a bullish engulfing candle here with a large high momentum bullish candle here, which could be our reason to get out of this trade now. Or if we're just trailing the stops down, just trail the stops and wait until they're hit. So yeah, just that's not really, as I say, I'm not advocating this as a trading idea or trading plan, but it's just showing you more the facts, showing you how well these levels act as support or resistance. Okay, I hope that makes sense again. So this is an example of using these fib extensions as stop losses. So we've come back down. This is a counter trend trade. We've come down, bearish move down, slight retracement up, bearish move down again, forming this double bottom. So we've had a large wick here. Price is rejected off of this level, so the sellers are wearing out. And we've come back into this level to retest these lows here. We've had RSI divergence here, so again indicating that sellers are wearing out. So we'd be looking to enter long on this trade, so we'd be looking to buy within this zone here. Now, for placing our stop losses, we could, depending, I've written here, depending on your risk tolerance and backtesting results, it will depend where you stretch your fib extension tool from. I've got another example in the next slide, so don't worry. But rather than setting the stops at random pip amounts below the lows, so rather than setting a stop loss, say 10 pips below this low, by doing that, you're not really taking into account previous price action. So you're just setting it at 10 pips. If price had just had a little move, you know, from here, a little bit of consolidation, a little move down here, you just set 10 pips below. You're not really taking into account the fact that we've had a massive move down, which indicates sellers are quite prominent. Obviously, we've had this rejection candle here to say that they're wearing out, but they are quite prominent with this strong bearish move down. You might want to consider that and have stops even lower. So having just 10 pips all the time doesn't take into account this previous price action. So yeah, like back to the original point. So depending on the risk tolerance, it will depend, and your backtesting results depend where you stretch your fib tool from. So from here, I've just stretched it from the neckline of this double top down to the lows, and we could set our stops at the 113 level. So that's quite a tight stop. That's probably less than 10 pips below this. So it's quite a tight stop. taken into consideration the previous price action. And obviously we wouldn't have been stopped out, we'd have had a nice winner here if we entered long on this trade. So again, using the tool alongside other reasons for entry, we've had the double top, we've had the RSI divergence, double bottom, sorry, RSI divergence into maybe another Fibonacci level, whatever, and then wait for a candlestick entry reason and placing the stops at the 113 level. If your risk tolerance is not this high, so if you don't want these tight stop losses, although it increases your risk to reward ratio, it's quite often, it's quite a risky trade to take. The higher the risk reward, generally the more risky the trade, the more likely you're going to be stopped out. So if you want a bit more leeway for your stops, you could stretch the fibs from higher up, as so, which increases your stop loss, so increases the room for movement if your trade is wrong. So this is basically an invalidation level. So you're saying if it gets to this 113 level, your idea is no longer valid, no longer makes sense to go long. Obviously we've broken this low here, so technically we're then in a downtrend. But it gives room for large candle wicks like this, so we might enter this zone and it might wick down, maybe stop hunted or something like that. If that stop hunt thing doesn't make sense to you, I think I mentioned it briefly in the volume indicator analysis, so check that out on my website. That'll explain what a stop hunt is. But yeah, so it avoids you getting stopped out by these large wicks here by having a stop loss a little bit further away. So you can restretch the fibs rather than from the swing high here to the swing low. You increase the distance to your stop loss by putting it from the swing high here to the swing low here. Now obviously this is going to depend on your risk tolerance and your back testing results. So when you're back testing this stuff, try it either way and see what is best for you. Obviously this way, from this swing high to this swing low, you're going to have a tighter stop loss, better risk reward ratio. So you're going to win more compared to how much you're risking, but you might get stopped out more. So this way it might work better for you because you might have a better win ratio. Although you're not winning as much as you're risking, you'll have a better win percentage. And doing the maths, it might work out better either way. So it's important to, let's say it's important to backtest all of this stuff. But that's an example of how to use the extensions as your stop losses. Now, this is where we get a bit more complicated here. So we're entering into the advanced and harmonic patterns. I say this is not the purpose of this lecture, so I'm only going to cover a brief overview of how these patterns are formed. Because they are solely based on Fibonacci levels, I thought it kind of makes sense to include them into this lecture, but there's so many different patterns and so many factors involved with how they form that they require basically a whole different lecture just for themselves. So I'm only going to cover the basics here and just provide one example. It's not really that important if you don't understand it in this lecture, because there'll be others on my website as well to explain these. But yeah, for more information, see the free educational content on ottrades.com to understand how these patterns are formed and how they should be traded. Now, there's a reason they're called advanced patterns. These should be one of the last things that beginner traders attempt to understand. So if you're going through the motions of learning about Forex trading, you need to understand price action, how the markets move, get a feel for how they move. Concepts of support and resistance levels, I'll cover that in the Introduction to Forex Trading lecture as well. See that on my website as well. So yeah, understand how price action works, how the markets move, support and resistance, how and when to use certain tools and indicators. We're doing this now with these fib levels. Also the other indicators on my website, RSI, ATR, etc, etc. So you need to know how to use these tools and indicators, structure, trend, market conditions. You need to learn about all of this before even really looking at advanced and harmonic patterns. So yeah, have a basic understanding of all of the above before they can be utilized to their maximum potential by a trader. So in order to use the advanced and harmonic patterns, you need to understand how everything else works before in order to best utilize these patterns. I hope that makes sense. So I say, if you haven't covered any of that previously, I suppose you can basically stop the video now, but I'm not going to go into it in great detail, so yeah, bear with me. The important thing to understand about these Fibonacci levels, like most things in the trading world, nothing is exact. So these levels should be treated as zones rather than exact prices or exact price lines. So as we were drawing the tools earlier, the 382, 618, 50% retracement, whatever it is, are exact lines in the market. Now they shouldn't be treated as exact lines, so orders shouldn't be placed at exact lines. They should be treated as zones, because it's not going to work exactly towards those lines. Sometimes it will, but most of the time it doesn't work like that. And that's the same for any other indicator. They should all be given a little bit of leeway. So these zones work well in trending markets, as we've shown before. So most traders are going to be trend traders rather than counter trend traders. However, the market is only trending about 30% of the time, about 20 to 30% of the time. So 70 to 80% of the time the market is in consolidation. Now consolidation is where price trades within a limited price range, so creating a number of highs and lows and price movements up and down, rather than just continuously moving in one direction. It's indecisive, basically. So this is where advanced and harmonic patterns come in handy, because they enable us to take advantage of the consolidation, and by doing so we're able to trade 70 or 80% of the time. So although we don't catch these big moves down or big moves up, it enables us to trade more often and catch smaller price swings. So advanced and harmonic patterns are created by a series or sequence of price swings and retracements to and from certain Fibonacci levels. So obviously during consolidation, price is moving up and down all the time, and obviously we're plotting the Fibonacci levels from those swing highs to swing lows. So if you're in a trend, price isn't going to be going up and down towards these fib levels. If you're consolidating, price is going to be going up and down, in and out of these Fibonacci levels. I hope that makes sense. So to cover the basics of these patterns, they're basically formed by connecting 5 points. So 3 of which have certain characteristics relating to specific Fibonacci levels or zones. So 5 price movements. So the first 2 points are defined as the X point. This is the starting point of the pattern, and from that X point, price moves in one direction or the other, that's either up or down, from the X point, which is just the start, to the A point, which is just the initial price rally. So again, that's got nothing to do with any Fibonacci level, it's just price movement up or down from one point to the other, the X point to the A point. So the line between these 2 points is just an initial price swing. These first 2 points are not dictated by any fib levels. Without the following 3 points completing, which we'll go on to next, these first 2 points are essentially worthless. So this is just an initial price swing. If we don't get the following 3, there is no pattern. It's just this initial price swing and some noise. So we've got the initial price swing from the X point to the A point. The next point is a B point. Now this is the first point to be dictated by certain Fibonacci levels. Each pattern has specific rules for the B point. However, the fib levels will be determined by stretching the Fibonacci retracement tool from the X to the A leg. Now I'll go over an example of this soon, so don't worry about me blabbering on about this. If you want to just skip this and go straight to the example, if that works for you, then do that. But I'm going to cover this now quickly. So from stretching from the swing, call it swing high, which is the X point, down to the swing low, which is the A point, the B point is going to come in at one of the Fibonacci levels between that X and A point. The next point is C. Again, this has a different set of rules for each pattern. However, it's also dictated by specific fib retracement or extension zones. So the extension might be from X to A, so it's going to be below the A leg, which is in the example I'm going to give in a minute, we'll be using the extension tool for this C leg. Or it might be from the retracement tool from the A to B leg. So it's going to come between that swing between the A to B leg. It's going to retrace back between those 2 points. The final point is a D point, which marks the completion of the pattern, once again dictated by different fib levels depending on the pattern. So like I said, I'm going to use one example. It's a very well-known pattern. It's a Cypher pattern. It's an advanced pattern. So let's just get straight into that. So like I said earlier, we've got our impulse leg down, which is X to the A leg. Now without the following 3 points after this, this is just a random price move. So we've had that initial move down, X to A leg, no fib levels involved whatsoever. Next we have our B point. Now the B point for a Cypher pattern has specific rules relating to the Fibonacci retracement from X to A. So you can see here, we've had our impulse leg down from the initial start of the pattern to the A point, X to A. We stretch our fib from the swing high to the swing low, and we have specific rules for our B point to form. Now for the Cypher pattern, the B point remains valid so long as there's at least a 382 retracement, which we've obviously had. We've got past the 382, at least a 382 retracement of X to A, and no candle close past 618. So if price action moves up anywhere between these two levels, that will be our B point. Okay, so even if the candle wick, so like it does here, the candle wick exceeds that 618 level but doesn't close past it, that B point is still valid. So basically, so long as we've got a candle close between these two levels, then that is going to form our B point. So we've got X to A to B, and B point is completed now. Next is the C point. So we've got X to A to B. Now our C point doesn't take into consideration this A to B leg. We are using the fib extension tool from the X down to the A, so from the swing high to the swing low, we're extending our fib levels down past 100%, and the C point remains valid so long as there's at least a 1272, which is this green line here, 1272 extension of X to A, but no candle close past the 1.414 fib extension of X to A. So like I said about the B point, no candle close past 618. We've got no candle close past 1414. Now we've had this wick obviously exceed that by quite a way, but price is rejected off of these lows, and we've closed above the 414 level. So this C point is actually still valid. Even though we have breached the level, we've not closed below it. So long as we have a candle close in between the 1272 and 1414, so long as price enters this zone, it doesn't close past the 1414 level, that is a valid C point. So we've got extension of X to A between these two zones for our C point. Now finally, we've got D point, which marks the completion of this pattern. Now D point completes the pattern at the 786 retracement of X to C. So this swing down from the swing high to the C point, the swing low, not taking into consideration this A to B leg again, we're ignoring the A to B leg. So from the swing high, the X point, to the swing low, the C point, we get a 786 retracement, which forms the completion of this pattern. So conventional way of trading this, which I rarely do personally, but again that's going to be covered in my other free videos, free content on my website. But the conventional way of trading this would be to set a limit order, so a sell order. You're expecting price to bounce off of these levels, okay? Same, bounce off of the A, off the B, off the C, and eventually off of the D. So set a sell limit order at the D point at this 786 retracement of X to C, expecting price to move lower. So that is the completion of the pattern, and this has obviously been drawn up through TradingView, tradingview.com, and on tradingview.com you get a nice Cypher tool which looks like this. So this obviously marks the retracement. So the retracement of the B point retracement is from X to A, actually comes in at 0.41, so it exceeds the 382 but doesn't exceed the 618, it's at 0.41. C point obviously extends from X to A. The fib extension is 1.519. Obviously I said no candle close past 1414. We don't, that's just the wick is actually at 1519. And then the D point here completes at 0.0808 of that X to C leg. So 786 is just below that, but the actual wick exceeded that 786 level to the 0.808 level. So that is just a brief indication of these zones. So we can draw this Cypher pattern out nicely here. So that's what the Cypher pattern looks like. So once we've entered the trade, we obviously need to know where we're going to take targets and where we're going to place stop levels. Now, stop levels and targets are usually, if you're trading this conventionally, they're usually based on fib extensions and fib retracements again. So all of these advanced and harmonic patterns are solely based on fib retracements and extensions, which is obviously why I've included them into this lecture. So stops are placed past the X point, so higher than here. A stop loss is basically an invalidation level, so you want to get out of the trade once you know you're wrong. So once this pattern is invalid, you no longer want to be in that trade, so you just cut your losses out, okay? And this is based on fib extension tools. So stops can be personalized to fit the trading style, but the conventional way of putting them is the 113 of the X to A leg, like so. So the X to C leg, sorry. So stretched our fib extension tool from the C leg up to the X leg, and 113, so 113% of this move. 113 level is where we would place our stop loss. So if price hits this 113 level, if price continues to move higher, this pattern is no longer valid, so we should exit the trade because we're not expecting it to move lower anymore. We're basically admitting we're wrong and we're just cutting our losses here. This is where the pattern is invalidated. So stop loss here of 51.5 pips if we're setting a limit order. 51.5 pips from the D point, so that'd actually be a bit more from the limit order, but call it 55 pips, absolute maximum from that limit order at 786. So stop loss is at 113 level. Now take profits. Take profits are usually, conventionally, they're set at the 382. So you have two profit targets on these trades, a 382 retracement and a 618 retracement of the C to D leg. Now this is from C point to the D point, not the 786 retracement, it's wherever that D point goes. So if the D point moves higher, as long as it's within our zone before it's invalidated, but even if the D point comes up to this level, you stretch the fibs up. So we've got a 382 of that price swing. Okay, important to understand that these fib levels are from price swings, so you don't want to stop halfway up a swing. You need to continue stretching that fib level up to the price extreme. Okay, so like here we've stretched it up to the price extreme, the top, very top levels to the swing high from the swing low here, and that retracement from the C point to the D point swing high is at the 382 level. That's where we'll take our first targets off. And the 618 level is where we'll take our second targets off. I hope that makes sense. So usually once these first targets are hit, we don't want to, so if you imagine the risk reward on this trade, call it 1-to-1, 51.5 to 49.1.4. So just call it 1-to-1 ratio here, just for the ease of this video. So you're risking 1 to make 1. Hope that makes sense. Now, once these targets are hit, price is obviously down here. So you don't want to be leaving your stop loss up here because you've now got whatever this distance is here, so 50 to 80, so call it 30 pips. You've now got 30 pips to get to your second targets, but if you leave your stop loss up here, you're now risking, what's that, 50, call it 50 plus 50, so 100 pips from where price is at the moment. You've hit your first targets, where price is here, you're now risking 100 pips just to make that extra 30 pips. So you're in a negative risk reward ratio, and not just a little bit, you're in a massively negative risk reward ratio. So once the first target's hit, you want to secure those profits, so move your stop loss down to break even, so where you entered the trade. So move your stops to break even, that way if price moves against you, you'll get cut out of the trade at zero, so you'll have taken your profits here. So say you won 100 quid, whatever it is, dollars, euros, 100, something. Here, you can no longer lose any more money, because as soon as it retraces back to break even, you'll just cut out the trade at zero. Rather than minus whatever it was you were risking, you'll cut the trade out at zero. So you're no longer risking 100 pips to make that extra 30. You're just risking basically nothing. It's a risk-free trade because you're at break even to make 30 pips. So I hope that makes sense. So initial targets at 382. Once those first targets are hit, move your stop loss down to break even, and then leave the trade to run to hit your second targets at 618. In this instance, we did hit it. Obviously, we hit the 382 here. We did start to move back up towards our break even level, and then price immediately reversed and hit our second targets at that 618 level. Just on a side note as well, obviously nicely bounced at this C point as well, at the 100% level, whatever, forming a double bottom again and a bullish engulfing candle. So yeah, you can trade that, maybe incorporate it into your back testing, see if it's worth taking third profits off at the C point. I don't know, you can personalize this whichever way you want. But just on a side note, you can see how well it reacted to this support level. As well, just to mention, notice how all of these fib levels relate to the previous swings rather than random price movements. So the B leg obviously relates to the X to A. So this previous price swing is what we're basing this B leg off of. And again, the C point is an extension of this previous price swing. So we're not just using random movements in the market, we're using the previous price action to determine our levels. So the previous price swing here is a retracement forming the B point. Previous price swing here is an extension of that previous swing to the C point. And a D point obviously doesn't take into account this little retracement up to the B point. We're taking into account this whole move down from the X point to the C point. We're taking into consideration a retracement of that whole price swing, this is an advanced pattern, but which is why the harmonics are similar, different rules, but similar in the fact that they take into account previous price swings, which is why they're called harmonic, because it's sort of following the flow of the market. We're not just randomly plotting these fib extensions on random price movements and little movements here, there, and everywhere. We're plotting them based on previous and recent price movements and projecting the retracements and extensions, which is why they're harmonic. I hope that makes sense, so that's just worth mentioning there. So that pretty much covers everything. I said, don't worry too much if this has completely bamboozled you and you're a bit lost with this. Go onto my website, check out the advanced patterns tab, and I'll cover them all in here, advanced and harmonic patterns tabs on my website. I'll make separate videos for each pattern as well eventually when I get around to that. But yeah, check that out. Say, don't really stress too much about these patterns unless you have covered all the other stuff I mentioned before: price action, market structure, support resistance, trends, all of that sort of stuff. You need to get a feel of how the market moves before you can actually implement these patterns into your trading. Because again, like everything else, they need to be incorporated with other entry reasons, whatever. So yeah, just to summarize, we've covered the fib sequence and its history. We've briefly covered that. Whether it's worth putting that in or not, I said at the beginning you can skip that, but just a background of how these levels have come about. Obviously how this sequence converts to fib levels and how we can use these levels in the financial markets. Not just Forex, people use these in the stock market, indices, bonds, options, whatever. Futures as well, whatever. How to couple these levels with other market factors, so support and resistance, in order to increase the strength or probability of your predictions. And that's what all of this is about. All of the indicators, tools, everything you've got is all about increasing the strength or probability of your predictions. So you basically want to be the casino. You want to have the odds in your favor at all times. So by adding these tools and indicators and stuff into your trading, that's what you're doing. You're increasing the odds into your favor. It's the rule of large numbers as well, guys. So long as the odds in your favor, even if you win some, you lose some, but so long as the odds are in your favor, overall, the rule of large numbers, overall, you are going to be profitable. And that's what it's all about, which is why it's important to backtest, because you need to make sure that the odds are actually in your favor. How to incorporate them into a trade setup, as well as helping manage a trade itself, stop losses, profit targets, briefly covered advanced and harmonic patterns. Not the purpose of the lecture, so don't worry if it's slightly overwhelming. Okay, that's basically it. So say thank you for watching this. Here's all my contact details if you want to get in touch with me if there's something I've missed out on this lecture. Check out my website. Everything on there is pretty much cover everything on there. All the indicators, tools, patterns are covered in there as well if you're at that stage of your trading. So check that out. It's all free. Yeah, check that out. So hopefully this has been some value to you. I hope you enjoyed it as well. So thank you very much for watching, and see you next time. Cheers. Ta-da.